Good.
Good evening, everyone. How's everybody doing this evening? I know you guys are muted, but I want to first of all thank everyone for being here with the LA South Chamber of Commerce to our financial wealth team. Tonight, we have a very exciting schedule lined up for you, some great speakers, and I want to make sure that everyone on here tonight take notes. You'll never know when you'll need your notes. I want to welcome our guests. First of all, thank you for joining us tonight. I hope you're able to walk away with a lot of great information. We will make sure that the guests have their information in the chat box. And you also want to put your information in the chat box. Okay, we will just to kind of give you an idea of what will take place tonight. We have two great speakers. They will present to you some fabulous information, well-needed information. It is all about our community, but at the same time, we would like for you to take notes. We would like to get your input tonight, and that's what our presentation tonight is all about. So once again, welcome, and let's get this party started. Thank you. At this time, I would like to introduce one of our team members, Terry Larry. She will present you with our very first guest of the evening. Thank you, Terry.
Good evening, everyone. Today, I have the pleasure of introducing our first speaker, Loreen McLeod. Loreen McLeod is an independent life agent, owner of Loreen McLeod Insurance Services. Loreen McLeod is a native of Guyana, South America. She graduated from St. Joseph's High School and was awarded a full scholarship to the University of London, where she earned a Bachelor of Arts degree in sociology and economics. Loreen immigrated to the USA, where she spent over 25 years in the financial services industry, attaining the position of Vice President / Manager of Bank of America. She holds professional licenses in life and variable life insurance and is a registered representative security, and holds a registered representative security license from FINRA. Throughout her professional career, Loreen has been driven by a passion of service to others and used the extensive knowledge and skills garnered from years of banking and finance to educate and improve the lives of people in the community she serves. She is active in many organizations, including Los Angeles South Chamber of Commerce and Shepherd Mills, and serves as board member of Concordia Lutheran Church and UG Foundation. Loreen is an avid traveler and enjoys the theater and reading. She is married and has a daughter, Serena Simon. Take it away, Loreen.
Well, thank you very much, Terry, for your kind words. Good evening, everyone. My topic is building your financial IQ. Welcome. Let me share my screen. Okay, fine. As Terry mentioned, my name is Loreen McLeod, and I'm an independent life insurance agent and business owner. I'm excited to be here to discuss financial goal setting as an important part of building your financial IQ. Now, while everyone's and why is that important, you might ask? Because we all care about our financial well-being. Admittedly, this may mean different things to different people, but nonetheless, having a good understanding of fundamentals is important to improving your financial life. While everyone's personal economic situation is unique, determining where you want to be, that is setting goals, is the first step towards financial well-being. In my talk today, I'll discuss some practical ways to reach your goals by applying simple financial concepts to your own life. My goal today is simply to provide you with a few ideas for setting goals that you can begin to apply right away. So let's start the presentation. Okay, I mentioned financial well-being in my introduction, but what is financial well-being? Well, it's having control over your day-to-day, month-to-month finances. It's having the capacity to absorb a financial shock. And, as I was looking at this bullet point, it just struck me that practically everybody on this webinar now, having successfully passed through COVID and having to deal this year with the whole situation of high inflation, pretty much all of us have suffered financial shock. It's also being on track to meet your financial goals, and it's having the financial freedom to make choices which will allow you to enjoy your life. In short, financial well-being is being able to do the things you love to do. Now, some of you may already have specific financial goals established. For example, making a much higher income. But first, let's consider some things you might want to think about when setting your financial goals. So,
Loreen, we do not see your screen. Can you share your slides, please?
Oh, I thought I did. I can see them. So, okay, wait a second. Let me see. Can you see them now? Okay, wait a sec.
No, just keep
Okay.
going. Yeah, it's
No, wait
okay.
a
Keep
second.
going.
No, wait a second. Can you see them now?
No.
No.
Did you tap on share screen already?
Let me see. No, I don't see share screen.
It should be at the
Okay.
very bottom.
Wait a sec. Let me go back to
It's at the
Zoom.
bottom and it's a green button.
Green button.
Okay, so I see that. And then I'm clicking on this. Can you see it? You share?
Yeah, Mom.
Now we see it.
There you go.
Okay. All righty. So let me clear that. All righty. So were you able to hear what I was saying though?
Yes.
Yes, we did.
Okay. I apologize, everyone.
Mom, if you press that button at the bottom, you can show it as a presentation. I know you like to do that. So bring your cursor down to the bottom right. Right, a little bit over.
This one here.
That one, yeah.
Yeah. Can you see that?
Press it one more time, Mom.
Yeah. It says you're sharing screen. Can you see it, Serena?
Yeah, it's okay, Mom. Just keep going.
But can you see it?
Yeah, we can see it.
Yes, we can see it, Lorraine. Just
Okay.
keep going.
Alrighty. So I was actually at slide number 3. Okay. So I'm going to start from here. I was talking about what's most important to you. Your financial goals cover a lot of territory, as you can see. So we really do need to prioritize. You may have goals for homeownership. You may have goals for getting out of debt or college financing for your kids or purchasing that car or going on that dream vacation, to name a few. So how do we prioritize all of these goals that we have? Here's the solution. Your financial goals should be SMART. Now, in this sense, the word SMART is an acronym. SMART goals are specific, they're measurable, they're actionable, they're relevant, and they're time-bound. It's a lot easier to remember these goals if you think of the acronym. This is a great way to make your goals achieve what you want them to achieve. So as you set your financial goals, ask yourself a few questions. Does your goal refer to a specific dollar amount or a specific percentage? Specific. Can you track your progress each month or each year? Are they measurable? Can you identify specific steps that you'll take to reach your goal? Are your goals actionable? Do you think, does what you are trying to achieve mean something important to you? In other words, are your goals relevant? And finally, does your goals have an endpoint? And do you have checkpoints or milestones along the way? Are your goals time bound? Your financial goals should also address your wants and needs, your wants and your concerns. Your want goals are the things you'd like to have or achieve, like home ownership, vacation, or that new car. Identifying your wants is a great way to set your financial goal. To do this, you simply have to identify how much money you have, how much money you'll need to achieve the want. You've got to set a time frame in which to do it, and then you must determine what it will take to get you there. Now, let me give you an example. Let's say you wanted to accumulate $15,000 for a down payment on the purchase of a home in 5 years. And yes, Anna, this is not today's reality. This is just because the numbers are a lot easy to calculate. So you simply would divide the $15,000 by 60 months to find that you'll need to save around $250 each and every month. And another way to approach your financial goal setting is around your financial concerns. These concerns are the things that keep you up at night, like paying your bills, like eliminating debt, and having enough money saved for your retirement. While you will all have different want goals, many people share the same concern goals. So why are these financial concerns the same for most of us? Well, let's take a look at that. So what keeps you up at night? A recent survey identified personal income, savings, retirement, and debt as America's most prevalent financial concerns. How many people would agree that these are your primary concerns? You can raise your hands. It certainly is mine. Thanks, Terry. In the interest of time, we'll take only 2 of these concerns and create a financial goal for each one. Okay, so we're going to use, here are 2 goals that we're going to consider. To save at least 10% of your net annual income each year, and to plan to have your debt, excluding your mortgage, paid down within 20 years. Now let's take a look at setting our savings goals. There are many things that people want to save for: emergencies, home ownership, college education, buying that car, or going on vacation. But how do you make saving enough a reality? First, you have to prioritize what is most important to you. So as you look at all these different goals, you need to determine which of these goals means the most to you. By setting a goal of, say, 10% of your take-home pay, or for business owners, 10% of net income, and allocating about a certain percentage of those dollars to each of your savings priorities, you may have a better chance of reaching your savings goals. What's most important here is that you want to get into the habit of saving and saving a predictable amount of money each month. That's absolutely the best and only way to get your savings on track. I want to give you a short example. A few years ago, well, a lot of years ago, when homeownership was one of my goals, I knew immediately that I needed to accumulate a certain amount of money for closing costs and a down payment. So what I did is that I established a automatic transfer from my checking account, which is where my paychecks went in, to my savings account each pay period. So for many, many years, I had $100 transferred from my checking account to my savings, and that is the way I accumulated the down payment and the savings the down payment and the closing costs. And by the way, even even today, I have never canceled that automatic draft. It's still in place, and I'm using that as my savings emergency fund. So these are really simple, very, very simple practices that any one of us here can put into practice, and I'm here to tell you that it does work. Now, there are two places in which your savings can come from: new income or reduced expenses. New income, for most people who are wage earners, usually comes from getting a raise from your employer or from receiving that bonus. For business owners like ourselves, new income usually comes from getting new clients or introducing a new product line, which will encourage people which will stimulate somebody's interest in your business. And so that's the way you would earn your new income. The other reason is by reducing your expenses. When looking to reduce expenses, you should have a detailed monthly budget, which includes a line item for savings. Everybody is familiar with the mantra that says, pay yourself first. I know Opus says that all the time, and that is absolutely the case. And whenever you're talking about accumulating your savings, just always consider paying yourself first. Now, with a budget, you can really begin to see your needs and your wants plainly. And with a few simple decisions, you can stop unnecessary spending and begin to identify money you may be spending needlessly and funnel that instead into a savings vehicle that will grow over time. Now, let's talk a little bit about setting a debt repayment goal. Now, this is a really challenging problem for a lot of us. And I just need to say to everyone here that if debt is a problem for you, you're not alone. In fact, a recent survey in September 2018 states that the average US household carries credit card debt of around $15,000, car loans debt about $28,000, and student loan debts of $47,000. However, in 2022, the aggregate numbers for US households went up enormously. In 2022, credit card debt has increased to $61 billion and $94 billion in auto loan debt for US households. So these numbers pretty much signify how much of a problem debt is. These are, you would agree, big numbers. And for those of us carrying debt, it might feel overwhelming. So what can be done to alleviate the financial stress that we all experience from carrying debt? Here are a few simple things you can do to reach your debt elimination goal. First, you've got to know your debt. You have to understand who it is with, what are the interest rates, and what are the terms. 2, know good versus bad. What do I mean by that? You have to understand the difference between good and bad debt. For example, good debt, for example, a student loan can provide value down the road, like a better and higher paying job, and can strengthen your financial position and your credit rating. Bad debt, like credit card balances, not credit cards, but credit card balances, has no future value and can cost more in the long term. It can also adversely affect your credit rating and your ability to borrow more. Setting priorities. Once you understand your debt, you've got to set your priorities. For example, begin by focusing on paying off the highest interest debt and other bad debts first. Now, having financial goals can help you achieve your financial well-being. In conclusion, I want to say you need to look at this whole exercise in financial well-being as a journey where you've got to map out where you are now and consider where you want to be. However, oftentimes taking the first step and identifying your financial goals can be the hardest part. But remember, nothing is set in stone. The goals that you set today most likely will not be the goals you have in future. The key is simply to get started so you can get on the road to financial well-being. Thank you for your attention. Does anyone have any questions?
Hi, Mom.
Any-
I have a question.
Okay,
I'll stop sharing.
okay, very good. Thank you so much, Lorraine. Awesome presentation. Who did we have with their hands up that had a question? Or
It was me, Serena Simon.
okay, what is your question to Lorraine?
So Mom, for people who might be trying to prioritize, I know something that you mentioned throughout the PowerPoint was prioritizing things. So what is your advice to people who may be trying to maybe struggling to save, but also struggling to pay off debt at the same time? Like if you were in that position, how would you best go about that?
Thank you, Serena, for your question. Well, you've got two very interesting options, either saving or paying off debt. For me personally, I would always start by paying down on my debt, because once you and the way that you want to do that is to focus on say your credit card that may have a very high balance. So you want to eat away at that. So you focus on making that payment, pay a little bit extra in order to get that debt paid down. And once it gets to a position that is comfortable, then you want to go ahead and set up that automatic transfer from your checking account to your savings. Start by a small amount. 10% of your take-home pay. It could be $50, $100, but get that started as well. But always start by paying off your debt, or at least paying down on your debt. Thank you.
Awesome,
Thank you.
awesome.
Very good, very good. Any other questions from our audience? Okay, at this time, I do have two questions that Lorraine would like to ask our guests. One of the questions is, number one, as discussed in her presentation, financial goals should be what? SMART? And does anyone out there know the acronym to what SMART stands for? Maybe I should say, did we take notes? Anyone? Don't be shy. What
SMART,
does SMART?
specific for SMART, right? You want to be specific on the goal that you choose.
Mhm.
Measurable.
Very good.
Anybody else want to take a shot? I want to give them an opportunity as well. Did anybody else take some?
Achievable,
What's
Okay.
achievable, actionable,
Mhm.
Very
relevant, and time specific.
Or time bound, correct?
what's R? It's SMART.
Relevant.
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 Relevant. Relevant is the word. Okay,
Well-
very good. So we are listening, okay?
And what's T for? Nobody said T.
Time bound.
Time bound.
Time bound. Okay. Well, we had everyone participating in answering that question. So why do you go ahead and ask a second question? And
The
we
second
only
question.
want one person to answer. The first person that puts up their hand is the one that's going to be asked the question. So
But
go
you know, our
ahead.
first person did finish that SMART, okay?
I know, that's
Thank
why
you,
we
guys.
can't assign anything.
Trying to give them an
Right.
opportunity. Give them opportunity.
We're giving them an
Okay.
opportunity again. So here's another question.
Okay, we're gonna move right along, okay? What is an important element of setting your goal, financial goal? What's an important element of setting your financial goal that you heard in our presentation tonight? Anyone? My goodness, my goodness.
I believe she said, setting priorities.
That was one, but there's
Preparation,
one particular. Calvin?
preparation.
Oh,
No,
well, let's keep going.
okay, Serena said one of them. Mhm.
Okay, but we have one answer. We have one
Right.
answer. We don't have that answer. So,
You have
What was-
preparation?
okay, that was one.
Okay,
But well, I'm looking for a certain answer, okay?
Setting aside funds on a monthly or, as much as you can.
It's
We
a
did
gene-
talk about that.
did that. We sure did, but
did.
we're looking for a generic word.
Something very generic
It's
that
very
is very
jo-
important.
yeah, it covers prioritizing is part of it, but what are
Right.
we prioritizing? What are we prioritizing? We've got so
Budgets.
much going on. We have a situation with so many things that
Let me
Our
change that.
goals. Our goals.
concern us. So what are we looking for then?
Well, let me put it this way, before you can address any of those areas, you have to have two things in mind.
Can
Yeah.
you ask the question again?
A budget.
Okay, what is an important element of setting your financial goals?
You
What's
have
a
to
very
have,
important element?
you have to know your starts with a W and your starts with a C.
Your
Stop it,
wants and your concerns.
Concern is
Yes.
one, and what's the
Your
W?
wants. Your
Wants.
wants.
Wants
Wants and
and
Wants and
concerns.
concerns. We thank you very much, Serena. She got that right. Well, now, we are giving you a gift card tonight on behalf of Lorraine and the LA South Chamber. You will receive a $20 gift card that you can shop with the chamber at any of our vendors that you choose to. Congratulations. Okay, give it up for Serena.
All right, so Serena, good job. All righty.
Hand claps, okay? Well, I thank you, Lorraine. Excellent presentation. if we just follow these rules and steps with our lives and our money and trying to get ahead, we will be so much farther in advanced.
Yeah,
The problem is sometimes is that we don't do that.
right.
We want to kick the can down the road and want to do what we want to do forever. But like Lorraine was saying, in order to reach your goals, to be in a better financial situation, these are the things you're gonna have to put in place.
Yeah.
Awesome presentation. Thank you so much, Lorraine. We must move on, okay?
right.
At this
Thank
time,
you.
thank you, Terry, as well. At this time, I would like to introduce Michael, which will be introducing our next guest. Okay,
Okay,
I'm sorry,
actually, it's
Melvin.
Melvin. Yeah, actually, it's Melvin.
Melvin, help me out. I didn't even see Melvin, okay?
Yes.
Melvin, would you please take the floor?
Excellent. I'm really excited to introduce our second speaker today, Karen Foster. Karen is an amazing young businesswoman. She's a native of Los Angeles, grew up in San Fernando Valley, now living in Inglewood. And she was inspired, I should say, and driven from her father. Her father who worked at Lockheed, and he had 2 side businesses, and that inspired her to go into business for herself. So first she went and got a BA degree from Chaplin University, and she became a mortgage broker and a real estate broker, which requires 2 licenses. And she has been in the real estate financial service industry for over 25 years and is the owner of Trinity 3 Investments and Grove Capital, Inc. Her purpose is to help her clients build generational wealth and passive income through real estate investments and financial literacy. So please help me welcome Karen Foster.
All right.
Thank you. Thank you, Melvin Burrell, for that wonderful introduction. My name is Karen Foster, and my topic tonight is why homeownership is a good financial investment. Please allow me to share my screen. Okay. Okay, so to share a little bit more about myself, as Melvin said, I am the owner of Trinity 3 Investments, Inc. and Grove Capital. I started in real estate in 1998. I am registered with the National Mortgage Licensing System Registry and also the California Department of Real Estate. I am also state certified through Caltrans as a minority-owned, woman-owned, and disadvantaged-owned business enterprise. My motto: I help clients build generational wealth and passive income through real estate investments and finance. My purpose is serving God's people. My passion is helping others achieve their dreams and goals. My relationship values, my core values are the foundation of everything I do, both personal and professional. And these words I live by in the infamous words of Zig Ziglar: you can have everything in life you want if you will just help enough other people get what they want. I am what you call a life learner. I am consistently developing knowledge and honing my skill set so that I am able to share this information with my clients as well as the communities that I serve. Now, the topics that I will be talking about tonight are the benefits of homeownership, Mortgage 101, pre-qual versus pre-approved, loan programs, including down payment assistance, and why working with a realtor to purchase a single family home or units. Okay, let's talk about the benefits. Ownership. When you buy a home, you are investing in yourself. This is your piece of the American dream, okay? Ownership allows you to do whatever you want with your home. You're not paying your landlord's mortgage, you're paying your own mortgage. And in the interim of doing that, you are building appreciation. As you pay your mortgage, you also acquire equity. And with that equity, you can look at equity as a savings account. This is money that you can use in the future if you want to make home repairs, if you want to send your kids to college. If you want to start a business, you can utilize the equity in your home to do just that. Tax savings. There is a benefit of tax savings where you can write off the interest on your mortgage insurance as well as your property taxes. There's also financial stability. When you purchase a home, you basically become a pillar in your neighborhood. You have stability. Your children are able to go to the schools within the area. You get to know your neighbors, and this is a great way to build financial wealth. This is wealth that you are able to pass down from one generation to the next. You can also utilize real estate to build your investment portfolio. Why real estate? Real estate is a better rate of return versus the stock market volatility. We've all seen how the market stocks go up and down. The market sometimes crash. Well, real estate is a stable investment. As a matter of fact, 90% of millionaires created their wealth through investing in real estate. There are tax advantages that we just talked about. You can leverage real estate to grow your wealth. So you can start with one property and propel into other properties in the future. You have more control over your investment. There is capital appreciation, and you are able to diversify your portfolio over time. Okay, Mortgage 101 versus pre-approved. Okay, both approvals, basically what they do is provide you as a borrower with an amount of how much you are able to qualify, or what you can afford to buy a home. Pre-qual is more of a basic approval. We as lenders, what we do is we gather some information from you regarding your income, assets, and your credit. And then what we do is give you a general idea of what you would qualify for. We can also do what's called a soft credit pull. However, I will tell you that it is better to be fully approved, which is pre-approval. Now, a pre-approval process is a little more entailed, where again, we look at your meeting lenders, we look at your credit, your income, and your assets. We also do what's called a hard pull, okay? And then at that point, what my company does is we will take it a step further and we will place your file with underwriting for review. So within, say, 24 to 48 hours, we will come back with a conditional approval. And this approval basically shows the seller that you are serious about buying a home, that you have gone through the approval process and you are ready to move forward with purchasing a home, okay? Now, as a lender, what we look at is your credit, your income, and your assets, okay? FICO scores range anywhere from 300 to 850. And if you look at the credit pie chart to the right of the screen, you will see the credit mix of what the average borrower's credit is made up of. So 35% is your, I'm sorry, I can't see past this. Here we go. Move this over here. 35% is your payment history. 30% is the amount owed on your debts or liabilities. 15% is the length of your credit history. 10% is new credit, and the other 10% is types of credit used. We will also require your W-2s, 2 years of employment history. So 2 years of W-2s, 2 years of employment history, your 2 most recent pay stubs, 2 years tax returns, bank statements, and other assets such as your 401k, or if you have pension, or self-employed, 1099. We will take anywhere from 12 to 24 months of bank statements, 2 years tax returns, and we'll also look at your income and assets. Loan programs. Now let's talk about the standard loan programs that are available, which is FHA financing and conventional financing. Now, FHA financing is 3.5% plus your closing costs. And FHA is for not just for a first-time buyer, it's for anyone who has not owned a home in a 3-year period. Okay. Conventional financing can be anywhere from on the low end 3% down to 10%, and your closing costs. Okay, VA, 0 down, and we, meaning lenders, look at the DD-214 and your certificate of eligibility. Now for USDA, which is the rural development, okay, this is the agricultural loan. If you qualify, you can purchase a home 30 to 45 minutes outside of any metropolitan city across the county with 100% financing. No money out of your pocket. And how you do this is you ask the seller to pay your closing costs. Seller concessions, that means seller credit. So for FHA, USDA, and conventional, the seller can credit the buyer up to 6% towards their closing costs, and for VA financing up to 4%. Okay, let's talk about down payment assistance. Now, there was a conversation that was had in a prior meeting where Dexter McLeod had asked, and like he said, it's not that people don't want to buy homes. Okay, we all know that the majority of people would love to be homeowners, but oftentimes it's because they don't have the down payment, or maybe they have the down payment, but they don't have enough money for closing. Okay, CalHFA, which is California Housing Finance Agency, they have programs for first-time buyers. Now, these are the standard programs, which are FHA, conventional, VA, and USDA. CalHFA also has subordinate financing, which is layered with the traditional Cal HFA programs. Now, the annual median income, this is for low income borrowers, is $78,320. So if your income falls within that bracket, then basically you can utilize the programs through My Home, and that's where a borrower can receive up to, say, 3.5% towards your down payment, and then you can layer one of the other products to help with your closing costs. Now, one program that I'm very excited about that's rolling out in another week, March 27th, 2023, it is the Dream for All conventional loan, which is combined with the shared appreciation loan. And guess what? CalHFA is giving borrowers 20% down payment towards their closing costs. You can use it towards your down payment and your closing costs if you choose to. But if you utilize it, say if you split it between your down payment and your closing cost, and that will leave you with a small MI, which is mortgage insurance. If you apply the entire 20%, say, to your down payment, then you eliminate MI, which is mortgage insurance, and you ask the seller for assistance to help pay your closing costs. Okay, so that is a way for borrowers to get into a home with little to no out-of-pocket costs. Okay, now the minimum FICO score, we do not know just yet what the minimum FICO score will be. It has been rumored that it's going to be around 660, but we will know by next Monday. You are welcome to go on to the website, which is, I think it's calhaffa.gov. There's information there that you are free to look up, and you'll see this information for yourself. Now, I will tell you that the information on the Dream for All program is limited right now, but after next week, there will be more information. So the DTI, which is your debt to income ratio, is 45%. If you are at 700 and above, your back end ratio can be as much as 50%. The annual median income, get this, for LA County is 180,000. That's a lot. Now, this is for moderate income, okay? The annual loan limit for Los Angeles County is $1,089,300. This program applies to single-family residents, condos, PUDs, which are planned unit development, manufactured housing that's affixed to the land. There is a 8-hour home buyer class, which roughly will cost about $99. And you have the option to buy down your rate. Now, temporary buy downs are very popular in this market right now, but through Groves Capital, we are able to, and this is a case-by-case basis, but we are able to assist borrowers with a permanent buy down. And this is either a 3, a 2, or a 1%. It's called 3-2-1% buy down. Okay, working with the realtor to purchase a single family home or units. Now, this is something that I believe that my realtor partners, Melvin Burrell and Anna Queen Tutt, can attest to, that we as realtors, we have access to the MLS, we have access to pocket listings, and our professional network, which is the agent community. So as realtors, we are bound by a strict code of ethics and expertise. We have taken years of our time and our labor and hard work and, you know, gone after these licenses, and we do it to help our community and to help, you know, the people that we serve. Okay, so I will tell you that when you are shopping for a home, your realtor is your best friend, because they are able to negotiate for you. They know the market. They can get a better price for you and save you time versus you going in and trying to negotiate for yourself. Okay, they understand complex transactions. Give you an example. Right now, there are, especially with units, there are still tenants who are held up in landlords' properties, and many of these properties are being sold with the tenants in them. Problem with LA City and certain parts of LA County is there is rent control. So if you are buying properties with tenants in them, then guess what? You have to deal with the headache of removing those tenants if in fact you are able to, because we all know what's been going on with COVID-19 and with eviction process. Realtors are motivated to find you a home. That is our purpose. That's what we signed up for. And I will tell you that in working with a realtor, that they are your best advocate in this market, because we're in a market right now that's, it's up and down. It's a little tedious, but I will tell you that if you are on the fence or thinking about homeownership, then I will tell you to have a conversation with your realtor if you're ready to move forward, and meet with a lender, explore your options, and take advantage of this program through CalHAFA, because this is your entry into homeownership. This concludes my presentation. Thank you very much. Do I have any questions?
Awesome.
Oh, I'm sorry.
Oh, no, go ahead. Go ahead. So we have Christian, go ahead. Terry?
I had a question. Does the HAFTA only
Uh-huh.
apply to new buyers? Instead of people who own property already?
Right. Yes. Basically, with this program, you cannot have owned a property. So you would be considered a first-time buyer. It's not for like people who already own property. No. It is a California product only too. It's not in any other state. But the reason being because California is one of the highest appreciation states in the US. So that's why it's being rolled out in California.
And you can't use it for an ADU.
Now I know I am seeing that you can, and don't quote me to something too, that I will have to double back and ask my AE, but I do believe that you can purchase a home that has, say, an ADU in the back, like a garage conversion, but don't quote me on that. I will definitely find out and get back to you and let you know.
Thank
Okay.
you.
We have more questions. I think the hand was raised for Serena first, and then there's another question from Lorraine. So Serena, go ahead and deliver your question to Karen. Thank you.
Is it in the chat?
Let's see if it's in the chat.
Sorry. No, I was muted. I'm sorry. Guys,
Okay.
Okay.
hi, Miss Karen. I had
Hi.
a question.
Sure.
I'm 25 years old, but eventually I aspire to have to be a homeowner like my mom in Los Angeles County. And currently I'm living in Dallas to basically save money. I'm living on my own in Dallas because the cost of living is significantly cheaper here. But the goal is to be a homeowner in Los Angeles someday. What steps that I can take to prepare myself for all that comes with being a homeowner in Los Angeles?
Well, I will tell you that you are on the right track as far as preparation, but the things that I listed in one of the earlier slides that you will need to have and what they'll look at is your, now, as long as you have stability in employment of 2 years, you have your W-2s, you have your bank statements. I do believe if you have never owned a home, and I don't know, like I said, my realtor colleagues can actually assess or help me on this, but I do believe that you can purchase a home in California, although you are living in Texas. But you said your mother lives here too, right? Your mother's here, rooted in California.
Yes. Mm-hmm.
So I do believe that you can purchase a home here, but I would say for you to continue saving. Are you in school or are you out of school or?
Yes, I'm out of school working full time.
Okay, so definitely you need 2 years with the same employer. So I don't know how long you've been on your job, but that's going to be a factor. And then with your income and your well, we can talk about that offline. What we can do is, for the sake of time, we can have a conversation offline, if that's okay with you.
Yeah, that's fine. Thank
Okay.
you.
All right.
Excellent. Excellent. Good question. The next question we have in the chat from Lorraine. Her question is, with regards to the CalHAFA, how low income requirement of 78,300, is this individual income or household income?
This is your household income, your annual income. So if you make that amount or below, then that's considered low income. And I will tell you that the rates are a little different. Now, the average rate that I'm seeing as of today is 6.875. But with CalHFA, their rates are, excuse me, their rates are a little more competitive. So to give you an example, this is for standard first mortgage loan programs. For low-income borrowers for FHA, today's rate is 5.75%. For conventional financing, it's 5.875%. Okay, then of course for VA USDA is 5.75%. Now for the down payment assistance, this is today's rate. Okay, what we're looking at for low-income borrowers is 6%. For moderate income borrowers is 6.125%. And then on the subordinate programs, the My Home Assistance programs, is 1%. So CalHFA's rates are a little more favorable for first-time buyers. And of course, it's because they are pushing homeownership. They want to see more Americans, you know, become homeowners. But keep in mind that you can also buy down the rate. That's something that you can do in this market, which is great to help you. So like, let's just say if you have 6% rate, you can buy it down anywhere from say like 2-4%, which is great.
And when you say, Karen, you say buy down, that means more down payment?
No,
lower-
what you do, how you do that is with seller concessions. You basically ask the seller for a credit, or you can even utilize if you are a candidate for the program. Now, if you are at the lower income, you would not be a candidate for the 20% down. So you will need, well, I take that back. You can receive 3.5% assistance from CalHFA, but you would need your closing costs. But still, that's where you can request that the seller pay your closing costs or have your realtor ask that in your offer.
Excellent. Okay.
I
There was
I have a question. There, someone asked me about mortgage insurance, which I'm not familiar with. And it was in a situation where someone had an illness. Now, can this be, mortgage insurance be in place after purchase if they already own the home, or is it set up at the time of the loan?
Mortgage insurance is generally set up at the time that you buy the home, like with FHA financing, and mortgage insurance is to protect the lender in the event of default, if the borrower defaults on the loan. But that's generally included at the at purchase when you're buying the property. Unless you're putting down 20% or more, then yeah, it's included at the onset when you're buying the property.
Thank you.
We have another question. Thank you for all the questions. Everybody's delivering.
Thank
good
you.
questions. Yes. Terry Larry has a question. Her hand is raised.
I'm trying to find out for my son, who's a millennial. And as you may know, millennials switch jobs a lot, but he has worked throughout, I mean, since he graduated from college, he and his girlfriend. So given that they change jobs often, they would have to have the same employer for 2 years?
Not necessarily the same employer, but the same line of work. So let's just say, just to give you an example, because I had this with a client. He was a security guard at one place, okay? And he had been a security guard for like, say, a year. He had an opportunity to go to work for the LAX. But as long as it's in the same line of work, I mean, security in the same, it's the same line of work, then, you know, that's okay. But now if you're switching from, say you're a security guard today, and then you're going into banking, that's not gonna work, because now, you know, we have two different fields. So that's what we mean when we say stable employment.
Good question. All righty. I see another hand by Loreen. Go ahead and raise your question, please. Oh, and well, I'm not sure if Lorraine or Opal, who was first. My apologies. I saw one hand, then another hand. So Lorraine, you have a question, then we'll go ahead and get Opal's question.
Yes, so Karen, with regards to the CalHFA loan, what is the down payment requirement? Because I noticed with respect to FICO scores, there was a difference in terms of that, as well as debt to income. But is there a down payment requirement, and is it in any way impacted by your FICO scores?
Well, of course, the better your score is, you're gonna receive, you're gonna be able to get a more competitive rate. I mean, we can do loans as low as 500. I don't recommend, me personally, I would not put a client in a home at a 500 with a 500 credit score, because I know their rate is gonna be ridiculous. And I personally don't believe in setting people up to fail. So if you say have a minimum of 600, 620, now you can buy a home at that rate, but like I said, your interest rate is not going to be favorable. The down payment assistance to 20%, keep in mind, we will know the exact rate by next Monday, but let's just say 660. Okay, 660 is a likelihood that the borrower would be approved for that particular program for the 20% down. And as long as you are above the low income range, which is the 78,320, but you say you're above that, but you're under the 180,000 median income level, then you'll qualify for the 20%, considering your credit and your assets.
Okay, and a follow-up question to that. Obviously it sounds very exciting to have a 20% down payment assistance, but is it really an assistance, or is there a second lien that is put against your house, or some requirements that require some other requirements?
That's the second half of it. That's what's called the shared appreciation.
Okay, so
Okay.
I
They're not just
heard
giving
that.
you the money for free.
Yeah.
Okay.
Yeah. Okay. So what's
Basically,
the shared appreciation?
Yeah, how the shared appreciation is combined with the 80% first mortgage. Okay, let me give you an example.
Okay.
Let's say you purchase a property for 500,000. Okay, CalHAFA is going to give you that $100,000 off the 500. That's the
down payment.
Down payment. That's the 20%. So your focus is that 400,000, that 80%. That's what your mortgage, what you're paying monthly. You're right. The 100,000 is a subordinate lien. It's like a silent second, but it is deferred, zero interest. Okay. Now, when you decide, okay, I want to sell or I want to refinance, that's when CalHAFA will say, okay, so let's say 5 years from now, because most people maybe live in their home average of 5 years. Let's say in 5 years, the property has appreciated to 640,000. Okay, your first mortgage was the 400,000. So CalHAFA is going to, out of that 640, they're going to look for you to pay back the 400,000 plus the 100,000 that they gave you. Okay, so that leaves you with $140,000 in equity. They will also share in a portion of the equity, a small portion, not all, your entire equity. But yeah, that's how the program works.
Okay, thank you.
Welcome.
Excellent. We have another hand by Opa.
Okay, I thought maybe this was kind of to what Lorraine was asking, but I've heard in the past, you have more than enough down payment. Your credit score is good, but you don't have enough debt. So how does that ratio work?
Okay, when you say you don't have enough debt, does a person have any debt at all? Like
no credit history.
No credit? Okay, that could be a problem because you do need at least, I think, like 3 trade lines. So if you don't have any credit, yeah, you need to, that person needs
No, I don't mean credit.
Oh, okay, I'm sorry.
I'm talking about debt. There's no debt. Not a
Oh,
lot
you
of
don't have
debt.
any
You have
debt.
good credit.
Good
Enough down.
credit, no debt. Okay, let me ask you this hypothetically. Has the debt been paid down? Or is, in other words, there's some trade lines
There
on your
hasn't
credit
been
report,
any, there hasn't been any debt. If it was debt, it was like $1,000.
but you don't have any trade line? Well, I don't mean you. The person doesn't have
Not
any
me.
trade, huh?
Not me.
Right, the person doesn't have any trade lines, any history, any,
No, not, well, I guess because they were paying by cash and everything was paid off,
okay.
like cars, things like that, everything was paid off.
They have to have some form of credit, I will say that. You know, unless you got cash to pay for a house, and if you're buying on
Well,
credit, you've got to
I
have.
think she has 2 credit cards, but they're paid off.
Okay, well then she has some
Cars are
credit.
paid off,
Okay,
but you know, they were telling her she didn't have enough debt.
that can also hurt you too. Like sometimes what people don't realize, little to no debt. I mean, no debt can be worse than, you know, bad credit. So yeah, you do have to build some type of credit history, trade lines. Like say for young people, what we
Right.
recommend is that they at least start to build credit now where they'll have a minimum of 3 trade lines, minimum. But of course, the more credit mix, the more history that you have, the better it is for you. But that
Even though
situation, that's something I would have to, you know, I would literally have to delve deeper into that, you know.
Okay, yeah, maybe I can talk to you about it, because even if she has more than the down payment,
Okay.
okay?
But it sounds like she has some credit history. So that's why I said it just depends on what that is. You know, I can't
Okay,
say without seeing or knowing.
knowing what the real deal is.
Mhm.
Okay, all right. Thank you.
Excellent, good question. I have one more question I want to bring on the table. These are some good questions, you know, being educated and you want to know what's going on. How do we get ready to purchase a home? So a question that I would like to throw out is, what are the 5 benefits of home ownership?
Tax deductions.
Collateral?
Tax
We're not
deduction.
raising hands. I'm staying out of it.
You have equity and appreciation. Don't have to pay a landlord
Now, what were the
and
5?
stability.
The 5 benefits. Remember the 5 benefits were?
That wasn't one of them.
It looks like somebody waving their hand. Loreen.
Lorraine has her hand up.
Yes.
Lorraine?
I was listening. It's home ownership, equity, appreciation, tax savings, and financial stability.
Woohoo!
Yes. All right.
You win the book. Thank
Yay.
you.
I'll be taking notes.
Yes, notes are very
Be
important.
important.
Good job. Good
Good
job.
job.
Thank you.
All
Yeah.
I got
righty.
the book. I got the book. I wanted that book.
Yay. Any more questions out there? All right. What about from our experts out there? Anything you want to add or anything?
Well, with the person who doesn't have debt, I'd be happy for them to go shopping with me and we will incur lots of debt.
And they'd have to pay it off. They pay it back,
Yes.
right? Increasing that credit score.
No, they'd have to pay it.
Oh, my
Okay.
goodness.
All righty. Well, you know, this was an excellent opportunity where we have the understanding of financial education, building wealth, building our budget. We want to be smart by developing our goals. I just want to give the opportunity before we close out, you know, this is a great presentation. Financial education is lifetime. So these webinars really is a help, and like to see more of our participants joining outside and coming in and listen to this information. But if I can get the opportunity for everyone to just give a 30-second pitch, who they are, and if you're a member or you're a guest, and we can close it out afterwards at 6:42. And then let's start off with, let's see, I'm looking on my screen. Let's start off with Michael Simon. All righty. Next person, Yolanda Horn. Introduce yourself, please.
Hello, Yolanda Horn. It's a little bit loud over here right now. And I'm also a realtor, been a realtor for over 20 years. And so just first time doing this Zoom with you guys. I'm sorry, it's a little loud over here. Somebody's yelling. I'm gonna go ahead and mute myself again.
Okay, thank you. All righty. Next person, introduce yourself.
I think Michael was ready, Vernell. He was
Go ahead,
unmuting
Michael.
himself.
Take the opportunity. You got 30 seconds. This is your elevator pitch. All righty. We're going to keep it going. Michael Burrow, Melvin Burrow. Oh my, we're going to call you Michael. All righty. Go ahead and introduce yourself.
My name is Melvin Burrell, and I am a broker associate with eXp Realty. I've been in business in the real estate industry for over 35 years, and I specialize in single family resident selling and also buying.
Yes, here it is. No, you put it on mute.
Revenue, I was gonna say revenue share, but also flipping properties. I do flips and I help people do those as well. And financing. I also do real estate mortgages as well.
No. Excellent. Thank you. All righty, Serena, go ahead and introduce yourself for us, please.
I think Michael was ready again.
Okay, Michael, this is a go ahead. Go ahead,
I'm
Michael.
sorry. I'm sorry. I am a life and Medicare broker.
Okay. All righty. Anything else you want to add to that, Michael? You got 30 seconds.
No, I just want to let the folks know that I'm a life and Medicare broker.
Thank you. All righty, Serena, go ahead and introduce yourself.
Hi, my name is Serena Simon. Loreen and Michael are my mom and dad. I'm a 25-year-old project manager at Goldman Sachs here in Dallas, Texas. And my long-term goal is to continue project managing, but in the sports and entertainment industry.
Excellent. All righty. All righty. Terry Larry, go ahead and introduce yourself. 30 seconds.
Hi, my name is Terry Larry. I'm a certified public accountant. I've been doing taxes and finances for about close to 40 years. I do compliance, planning, and then working with the IRS to reduce maybe some assessments that may be incorrect or that have been assessed.
All righty, excellent. Okay, Calvin, go ahead and introduce yourself. We got 30 seconds.
Excuse me. Good evening, everyone. Cal Johnson with Credit Card Savers. Credit card debt is increasing, as Loreen made note in her presentation. This is true. I'm with a startup company. We have an innovative algorithm that allows someone to take advantage of the programs that are already out there. Plus, we can customize our Credit Card Saver program to help people significantly cut their interest, their credit card debt. So take a look at our website, creditcardsavers.net. Thank you.
Awesome. Okay, we have Regina White. Go ahead and introduce yourself. We got 30 seconds. Regina, are you there? All right, I'll give Denise Ripley an opportunity to introduce yourself. 30 seconds, please.
Yes, I am a licensed life and health insurance agent. And I also specialize in Medicare enrollment. And, that's it.
All righty. All righty. And Anna Tut, go ahead and introduce yourself.
Good evening, everyone. My name is Anna Tut, like King Tut, but Queen Tut. And I am a realtist and realtor. I can't go into the realtist right now because I only got 30 seconds, but I don't just sell homes. I change lives. I educate, I motivate, I inspire, and I push you to the next level. And I'm a public speaker. Thank you so much. You guys, ladies, you did an awesome job. Take advantage of this.
Awesome. Thank you. And Opa, go ahead and introduce yourself. Thank you. 30 seconds.
Good evening, good evening. This has been an awesome webinar. You guys are just too much, okay? Thank you all for being on tonight. My name is Oprah Price. I am an insurance broker. I specialize in helping you protect your most valuable asset, which is you, your business, and all your family concerns. I've been in the business for over 35 years. I love what I do. And I help people with that most difficult question or that answer. How are you protecting yourself? So thank you guys for being on tonight. This was awesome. Thank you, Vernell. Thank you, Terry. Thank you, Anna. Thank you, Lorraine. Thank you, Karen. Thank you, Melvin Burrell. Just everyone, you guys are awesome tonight.
Yes, thank you. Well, I'll go ahead and give a brief introduction from myself. I am Vernell Taylor, and I'm a Legacy Union Bank member, but soon be transitioning to US Bank. I'm for now the regional manager for the student run branch. I will be moving over in a different position soon. I've been with Union Bank for 33 years, so my passion is giving back to the community, making a difference, especially in my current role, giving the opportunity to teach our youth, our families, and our communities the importance of financial education. So that's a big highlight for me, and building those relationships. And soon, like I said, with US Bank, continue that financial education opportunities for our youth. That's number one. So thank you everyone for joining the call. Great presentation. Thank you, Karen, for talking about, the opportunity, home ownership, building that generation wealth. That is very essential, and understand the basic of being a home buyer. That education part is very important. I really thank all the presenters. Lorraine, again, as I mentioned, the importance of budgeting your money and, making, understand the IQ, right, about your money and developing that budget, very important. And thank you, guests, and thank you for our live Facebook audience as well joining tonight. I don't know if there's any other questions or anything that we want to bring to the table before we finalize this webinar.
Thank you to the LA South Chamber of Commerce for allowing us to have this platform. And, it's truly needed in our community. There's no need to look around elsewhere. There's a lot of expertise right here. There's a lot of knowledge here. Only people would tune in. There's so much on this platform, so much to learn, and so much you can benefit for. So I do thank the LA South Chamber for allowing us that opportunity. We do these webinars once or twice a month. Visit the Chamber's website. You will always see our flyer there, who the presenters are, and just take advantage of the situation. It is free. Thank you again for joining us tonight. Thank you so much, Vernell, for all you do. Lorraine, Karen, Anna, everyone, you guys are just awesome. Thank you so much.
Thank you. Yes, we're not the average chamber. So I want to say good night to everyone. Done a good job, all the presenters and the guests asking questions. Good job. Good night to our Facebook Live audience as well. And until next time, have a great evening. And don't forget to check out the chamber, lachamber.com. And we have some upcoming events. And remember, financial education is next month, April